What's up YouTube? My name is Dylan. Welcome back to my channel. In today's video, we want to talk about stocks versus ETFs. Ultimately, we want to help you guys understand what the differences are, what the pros and cons are of each, and ultimately help you determine which ones are best for your investment strategy. So if you guys can do me a quick favor before we get started, click that like button down below. It's the big thumbs up. That helps YouTube promote my content so it can get my videos out in front of investors who are wanting to learn so I can help them on their investment journey. What is an individual stock? So an individual stock is ownership in a company. So think of companies like Starbucks, Target, Nike, Disney, Apple, some of those famous companies. Really any company that's publicly traded you can own stock of, but it represents ownership in a company. So individual stocks can be bought and sold through your traditional brokerage accounts or through IRAs, Roth IRAs, anything like that. But think things like TD Ameritrade, Charles Schwab, Robinhood, some of those famous brokerages. You can buy and sell individual stocks on those platforms. And generally speaking, the price of a stock is determined by the performance of the company. So if the company is doing really well, normally we see a stock price tend to follow. Sometimes the stock price actually gets ahead of the company's performance, but generally speaking, they tend to follow each other. The stock price will tend to follow the earnings of the company over time. So if you haven't watched my video on price to earnings, please check that out. I'll leave a link in the description below. But over time, generally, a stock price will follow the earnings growth of a company. So sometimes if a stock is not doing very well, you can look at the underlying business and see that it's actually doing pretty poorly. So these aren't always true, but generally speaking, the performance of the stock is tied to the performance of the company. So why own individual stocks? What's the benefit of individual stocks? So one reason why you may want to own individual stocks is for a higher dividend or higher dividend yield. So let's look at the example of PNC Bank. So PNC's current dividend is $4.60 annually, and that comes out based on the current stock price to around 4.30% dividend yield. So think of it this way. If you put your money in PNC Bank, if you put $1,000 into PNC Bank, you are going to get a return of around 4.3% annually based on its current dividend yield. So where are you going to find that in the current environment with low interest rates? You're not going to get that type of yield in a savings account or even a bond fund. So a lot of times investors will choose to put their money in individual stocks that pay a high dividend yield for that safe, steady flow of income. So another reason why investors may opt for individual stocks is greater capital appreciation or greater opportunity for capital appreciation. So let's look at Tesla. Tesla's basically shot to the moon over the past year. And if you look at a one-year chart, Tesla's up over 730%, which more than destroys the return of the S&P 500, which is up only 16% over the past year. So some investors will choose to go into individual stocks or more heavy into individual stocks for the opportunity to have a lot more exponential growth or exponential return on their investment. So another reason why investors may choose to go the individual stock route is they can put together their own basket of stocks to create their own diversification or their own mix to meet their investment needs. So in the example portfolio you see here, the collection of 12 stocks that we own are a diversified group across many different industries, and they all pay dividends monthly on different months. So perhaps you wanted income from that, and this portfolio would provide you with that by paying regular monthly dividend payments and that steady stream of income. So if you guys have not watched my dividend video and how to analyze a good dividend paying stock or a good dividend company, I recommend you checking that out. I put a link in the description below. But this is just another way you can use individual stocks to create your own diversification or develop your own investment strategy to meet your personal needs. All right, so we've talked about individual stocks, so now let's talk about ETFs. So what is an ETF? An ETF stands for Exchange Traded Fund, which means it's a fund, it's a collection of securities. So it could be a collection of stocks, collection of bonds, collection of commodities, collection of whatever. But the purpose is it's a group or a basket of those things, and they trade as one. So it's a diversified basket of securities that trade as one unit. So the purpose of that is to track an underlying index or a certain sector of the market or something along those lines. So let's go into a couple examples to give you guys an understanding of how ETFs are made up. So the first ETF we're going to look at is the ticker symbol SPY, which is the Spider S&P 500 ETF. It's probably the most widely used and most popular ETF out there. It tracks the performance of the S&P 500. So you can see in these two charts here that the performance of the S&P 500 and the performance of the Spider Shares ETF are identical. The performance is the same over the past year because the purpose of the ETF is to track the S&P 500 index. And you could also see here in the top 15 holdings of the SPDR S&P 500 ETF, the top 15 holdings are market cap weighted, just like the S&P 500 is, and it's the same weighting as the S&P 500 index. So the purpose of this is to match the return of the index. So if you're happy to receive the return of the stock market or the S&P 500, then you would invest in SPY to track the performance of the S&P 500, and you would get whatever that return is. So another ETF example is XLF, which is the SPDR Financials ETF. So you can see by the top 15 holdings here, some of the most popular financials in the S&P 500, like Berkshire Hathaway, JP Morgan, Citigroup, Wells Fargo, Bank of America, all those big banks are in this ETF. So when you buy this ETF, you're gonna get the aggregate performance of these banks. Now it's market cap weighted, so you can see the ones with the highest market cap at the top, similar to the S&P 500 ETF. So when you buy the XLF, you are basically buying the performance of the financial sector of the S&P 500. So the next one we're going to look at is MJ, which is a marijuana ETF. So I know marijuana has been really popular as far as the investing community, so they're very volatile. So you may not want to invest in a single marijuana company because they can jump 10, 12% or more a day. So you may feel more comfortable investing in an ETF, which is a broad basket of marijuana stocks. So if you look at the top 15 holdings, you see some of the famous ones in there like Cronus, Afira, Tilray, Canopy Growth, GW Pharmaceuticals. Some of the big players in the marijuana industry are in this ETF. So if you don't like the risk, or if you don't have the stomach for the volatility of a single marijuana company, you may be more interested in investing in this marijuana ETF that matches the overall performance of the industry. And the last ETF we're going to look at is the ticker symbol HERO, H-E-R-O, which is a online esports and video games ETF. So if you look at the top 15 holdings, there's some of the most popular video game companies out there right now. You got Activision Blizzard, Electronic Arts, Sea out of China. You've got things like Zynga, Take-Two Interactive, all the popular video game makers in this ETF. So if you want to invest in this space, if you think this space is going to continue to grow and you may not have the stomach for the volatility of an individual stock, an ETF may be the way to go. So it can give you that instant diversification for an industry or sector that you feel passionate about, that's going to grow and grow your wealth over time or appreciate over time. So what's the benefit of an ETF? Why would I buy an ETF over an individual stock? So the first reason is instant diversification. So let's take a look at VTI. VTI is probably the most popular total US stock market ETF out there. So it's offered by Vanguard, and you can see here the top 15 holdings are the top market cap weight companies in the US. So it is market cap weighted, so you can see the likes of Apple, Microsoft, Google, Facebook, all those big companies up near the top. But the instant diversification piece is key. So you can see that the fund has over 1,500 holdings in it. So when you buy this one stock or this one ETF, you are actually buying over 1,500 different companies. Now they're market cap weighted within that one holding. However, you get instant diversification. You can see here the breakdown of all the different sectors. So you're not putting all your eggs in one basket. You're not putting all your eggs in one sector, or you're not putting all your eggs in one stock. It gives you instant broad diversification of the entire US stock market, and it's also market cap weighted. So right now, what's driving the market? The big caps, the FANG names. Well, those are at the top of this index because they got the highest market cap, and this is market cap weighted. So one benefit of an ETF is that instant diversification across whatever sector or index you're trying to match. Another benefit of an ETF, or why you may pick that over an individual stock, is maybe you're not sure who the winner is going to be. So maybe you really believe in the industry or the sector, but you don't know who's going to come out on top or come out ahead, so you just want to invest in the sector. So think of the COVID-19 vaccine play. So right now we've got hundreds of different companies trying to come up with a vaccine for this COVID-19 virus. So if you invested in an index like the IBB, which is the iShares Biotech ETF, you can see the top 15 holdings here are some of those big vaccine plays like Biogen, Regeneron, some of those big companies that are actively working on developing a coronavirus vaccine. So if you put all your eggs in one basket and you invest in let's say Regeneron, because you think they're going to come out with the coronavirus vaccine and somebody beats them to it, well, their stock may drop or sell off because they got beat to it. However, if you invest in a broad diversified ETF that kind of tracks that sector, then you're probably going to come out ahead. Now, you're not going to get the type of growth that you would if you guessed right of who made the vaccine, but you're going to track the performance of the index. So if you're not sure who the winner is going to be, but you believe in the space, an ETF is probably going to be the way to go. So another area where ETFs are great is areas that you may not feel as comfortable, have as much knowledge about. So the one that really comes to mind is when you start diversifying abroad. You go into international markets or particularly emerging markets. So a good way to diversify in emerging markets and reduce your amount of risk is by investing in an ETF. Because when you start getting into individual countries and companies in those countries, you open yourself up to a lot more risk because they just don't have the same standards and same practices we have here and we're used to in the US. So an ETF can give you a quick, easy way to diversify in a specific country or over a group of countries. So let's take a look at the VWO. The VWO is the Vanguard Emerging Markets ETF. So you can see it's well diversified across many different countries. You can see it's in China, Taiwan, India, Brazil, some of those really hot emerging markets. So when you would invest in this is maybe you don't feel comfortable going all in on Brazil or all in on Russia or all in on Taiwan. So by investing in this ETF, you get a little bit of all these different countries listed here at these different percentages. So it can be a quick, easy way to diversify, give yourself emerging market exposure, which you definitely want in your portfolio, without taking all the risk of going into individual countries or individual companies within those countries. So let's take a look at the Russia ETF, so RSX. If you'd put all your money in the Russia ETF back when it first came out, you'd be down over 40% on your money. So this is one reason why you may not want to go all in on a certain country or all in on certain companies in certain countries because there's just a lot of extra risk. So the VWO could be a great way to diversify into emerging markets and really reduce your risk exposure. So if you guys haven't noticed it already, I'm a big fan of ETFs. I actually prefer ETFs over individual stocks, which I'll explain later in the video. However, I do think there's a place in your portfolio for individual stocks, but there's one major downside to ETFs, and it's a limited downside, but it is called the expense ratio. So what the expense ratio is a fee, because basically there is fees associated with owning those ETFs, because in order to put those collection of stocks together and manage them and make sure they stay balanced and everything like that, well, somebody has to manage that. There's a company out there, so whether it's Charles Schwab or Vanguard or Fidelity, whatever fund you choose to buy, they still have to technically manage that fund, and there's administrative fees and everything like that. So when you buy an ETF, you always want to look at the expense ratio, and generally speaking, the lower the expense ratio, the better, because if you have to pay less in fees, then that's just more money for you, and you're ultimately going to compound your growth over time because you're not shelling that money out in fees. So let me show you guys an example of how exactly expense ratio fees work. So this example is going to show you a hypothetical situation where you took $10,000 and you invested it over 20 years into several identical ETFs, and the only thing that changes is the expense ratio or the fees you have to pay. So if you zoom down here to the bottom, you can see over the course of 20 years, the lower the expense ratio, the more money you have in your pocket. So at the end of this 20-year period, if you had invested in the ETF with a 2.5% expense ratio versus the one with a 0.5% expense ratio, you would have given up over 31% of your total gain in the amount of fees. That comes out to over $21,000. So I don't know about you, but I want that $21,000 in my pocket because it can continue to grow over time and compound, and I can grow my wealth. So this just shows you that expense ratios, although they seem small, can really add up over the course of your investing lifetime. So what's better, an individual stock or an ETF? Well, a lot of it depends on your personal risk tolerance. So let's take a look at GE. So if you had invested all your money in GE, which was once one of the bluest of blue chip companies out there, if you had invested your life savings in GE back at the height of the dot-com bubble back in 2000, you would now have lost 90% of your money. So think of that for a second. You put your life savings into a company that you think is the safest company out there, you've now lost 90% of that over 20 years later. So That's one reason why ETFs provide you a better opportunity for diversification, is because there's just a lot less downside risk because you're not relying on the performance of one stock or one company. So if you take a look here, if you had invested your money in the S&P 500 over that same time frame, well, you'd actually be up over 130%. So you can see by diversifying and putting your money into a market or a group of stocks, it just gives you that diversification and a lot less risk, because even though the company may seem like the greatest company out there, may have a good balance sheet, may be well liked, companies go out of style all the time. A lot of companies that were around 20 years ago are the top companies that were around in the S&P 500 20 years ago aren't the same companies that are the top ones in the S&P 500 today. So companies go in and out all the time. However, if you match the performance of an index or a group of stocks, ultimately you're going to match the performance of those overall stocks, and you have a lot less downside risk. So another benefit of ETFs over individual stocks is just the amount of time commitment and dedication it takes to analyze individual stocks. So if you're not comfortable analyzing balance sheets, cash flow statements, income statements, which, by the way, if you guys don't know how to do that, I did videos on them and I left links in the description below, so please check that out when you get time. If you guys aren't comfortable analyzing those statements, or if you don't know how to calculate things like return on equity, and you don't know the difference between operating margin and gross margin, or perhaps how to analyze company debt, which I did a video on that as well, please check that out when you get time. If you guys don't know how to do those things, then it's probably best to stick with ETFs, at least early on, until you gain that knowledge to invest in individual companies, because ultimately we want to invest in individual companies that are healthy companies and financially set, so they can grow over time and grow our money over time. So until you have that knowledge, it's best to stick with ETFs. It's just going to give you guys a lot less risk and greater protection of your assets. So ETFs are also a great way for people who just want to set it and forget it. And the best way to do that is with a target dated fund. So Vanguard has a lot of these. So the one you're looking at right here is the 2045 target dated fund. So you can see it's pretty diverse. It's in US stocks, it's in foreign stocks, it's in some cash, it's in some bonds. It's got a diverse portfolio. Well, what's good about a target dated fund is this fund is automatically going to rebalance every year. And as you get closer to whatever target date you pick, so for example, this one's 2045, it's going to get less risky. And what I mean by that, it's going to automatically shift out of stocks and more into bonds and more fixed income type securities. So this is a perfect way to just set it and forget it. If you want to be very passive, you can buy a target dated fund. You can say, I want to retire around X date, for example, 2045, and just put money into here every month, week, semi-annually, annually, however often you want to put money into it, and just set it and forget it. The fund's automatically going to rebalance and rediversify as you get closer to retirement to give you less risk exposure to the stock market. All right, so we talked earlier about investing in individual stocks for greater capital appreciation. So one reason why you might go into ETFs is if you're okay with just an average return. So if you look at the chart here, the average return for the S&P 500 over the last roughly 50 years or more has been 10% annually with dividends reinvested. So if you put your money into the S&P 500, good chances are you're going to return 10% annually. Now that doesn't happen every year, but however, over the long term, you can generally expect to earn 10% on your money. So ETFs may be a good choice if you just want to be passive and earn whatever the return of the stock market is. So let's say you want to try and beat the market. You say, hey, I'm good at picking stocks. I can get more than a 10% return. So that would be a perfect reason to go into individual stocks. Maybe you want that challenge. Maybe you want to try and beat the market. Be aware that over 88%, almost 90% of fund managers cannot beat the stock market over long periods of time. So most people fail. Most people do not beat the stock market, do not beat the S&P 500, which is often used as a benchmark. So if you want to try, that's great. More power to you. You can invest in individual stocks all you want and try to beat the market. And in fact, some people will. However, over long periods of time, we're talking 10, 20, 30, 40, even 50 years to retirement, it's very hard to consistently beat the stock market every single year. There may be years where you do beat it, there may be years where you don't, but in aggregate, over the long time. Generally speaking, almost 90% of fund managers cannot beat the stock market. So ETFs may be a good way to just get the return of the market, and perhaps you can invest in individual stocks maybe on the side with a smaller percentage of your portfolio to try to get greater capital appreciation there, but not with all of your nest egg. So when it comes to individual stocks versus ETFs, which one's better? Well, you got to ask yourself, can you stomach the volatility? So look at these two graphs here. The first one is of the financial sector, the XLF. We talked about this earlier. It's had a poor year. We know that. Most everything's had a poor year. It's down 21%. So can you handle losing 20% of your money? If you invest in Wells Fargo, in this one over here, which is a member of the XLF, you'd be down almost 50%. So you can see just by investing in an ETF, even though it tracks the underlying index, even though the same individual stock is in that ETF, your risk is a lot less. Even though the whole sector has performed poorly year to date, it's not nearly as bad as if you had picked a specific stock out of that sector. So even though they've all done bad, one sucked just a little bit worse. So you're probably asking yourself, you've given me all these pros and cons, individual stocks versus ETFs, blah, 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 blah. What do you do? So what I do, I primarily invest 90% in ETFs. So I have a well-diversified portfolio, which I'll be doing videos on in the future about proper portfolio diversification, what it makes sense to invest in a Roth IRA, regular IRA, different retirement accounts, 401k, stuff like that. So I'll be doing videos on all those, but generally speaking, I have a diversified basket of ETFs, and then I have a small portion of my nest egg, I'll call it, that I invest in individual stocks, because I like to try to beat the market too. There's a company that I may believe in, so I put some money in it to try to get some capital appreciation, some really strong capital appreciation or really strong growth, something along the lines of Tesla, even though I didn't invest in Tesla and I wouldn't invest in Tesla, but that's just one example. So companies like that. So another thing you can try to do is find undervalued companies. Sometimes the market will misprice companies and they'll actually be trading at a discount to what they're actually worth, and you can do discount models and cash flow analysis and stuff like that to try to find their intrinsic value or true net worth. So some of those things are fun and challenging, and I enjoy some of that. However, it's a very small portion of my overall portfolio that I invest in individual stocks, because I want that broad diversification, I want that broad exposure, and I want that limited downside risk. All right, guys, so that's it for today's video. So hopefully you understand the pros and cons of ETFs versus individual stocks, and it gives you guys some things to think about, some things to analyze when you put together your ultimate portfolio for your investment strategy. So if you guys like this video, again, please give it a big thumbs up. I also encourage you to subscribe to my channel. This is going to be your one-stop shop for all your financial and investment education. And I just appreciate you guys joining me today. So I will see you guys in the next video. Thanks again. Peace.